Good morning and good afternoon and good evening from wherever you're watching me from, whichever part of the world you're watching me from. You're welcome to the channel. Those my friends from Nigeria, those in US, those in Canada, UK, those from Barbados, anywhere you're watching me from, you're welcome to the channel. And not forgetting my friends from India. You're all welcome, guys. You're welcome. The question most of you guys ask that today I want us to tackle is there a better indicator? I've made one video previously, long time ago, on this particular topic, but today I want to give in-depth knowledge on whether there is a better indicator and which one is best for you and how you are going to use them. So if you're here, then welcome back to the channel. And without wasting my time, we will begin and we will see what we can cover for today. So the question is there a better indicator and which indicator is best for you? Well, it depends on who you ask and also what the person knows. Before you can answer these questions, you must understand certain things. In trading, we have traders who trade with just indicators alone. Their main focus is trading with indicators. So we have several indicators I'm going to show you on the chart. And we have those who trade with price action, which means no indicators and just purely price action and price data on the chart. Their job is to use chart patterns and some candlestick patterns to trade. And we have those who combine both indicators and price action. At the end, I'll tell you which one is best and which one you can also incorporate into your trading. Those who trade with just indicators, what is their main focus? The purpose of indicator is to tell you what is happening in the market. So most people trade with indicators. They have several indicators. Like for instance, when you look here, you could see that when you go to insert and indicators, there are several categories of indicators. We have trends, where we have the adaptive moving average. We have average directional moving average. We have Bollinger Bands. We have double exponential moving averages, and several. These are all for trending markets. And we have the oscillators, where we have the average true range, the bear power, the bull power, the MACD, the relative strength index, stochastic oscillators, and Williams percentage. These are also all for oscillators. I'll explain to you what they are used for. Then we have volumes. Then we have this guy called Bill Williams. Bill Williams has a name in trading. You will never do trading without hearing of Bill Williams. If you've not heard of Bill Williams before, then it means you have to search for him. He was a great trader. He had a lot of softwares under trading. And then you can also customize your own indicators. So these are indicators people use to trade. And why do they use them? They use them to give them signals. For instance, the indicator can tell them when to buy or when to sell. So let's say you can also customize the indicators, for instance, so that when the markets reach a certain point, the indicator will signal them to buy or to sell based on some criteria. And when you're trading with price action, you trade with the purely price data on the chart. So let's say, assuming that this is your chart, right? Let's assume this is your chart. And mostly when we are doing the live trading, you realize that I trade purely price action, because the live trading, I trade with M1 candle, which means I have to be faster. So I trade purely with price action. Then we also trade both indicators and price action. What makes the difference is because I have traded indicators for several years. I've traded price action for several years. I've realized that none of them is complete until you combine some of them. So at some point, you can't trade just price action alone. At the same time, in some point, you can also trade just indicators alone, but you can trade both price action and indicators to give you an edge over the market. So which indicators are you going to trade? Are you going to trade with your price action, and which price action strategy? The indicators most of the time I use, as you can see on my chart, you realize that most of the time you will see, let me clean this. This is MACD. I don't normally use it. Most of the time you will see this. This is an awesome oscillator indicator. This one is called awesome oscillator. And this particular indicator has been on my chart for a longer time. And you don't understand why it is there. Today I'm going to explain to you. Moreover, when you come down here, you will see there is relative strength index. Relative strength index. It's also an indicator you have seen down here on my chart. Sometimes you also see moving average. For instance, when I open this of my chart and I insert my template, maybe template moving averages, and you can see I have moving averages on my chart. Why do I use them? And why is it that there are a lot of indicators, but I use only such indicators to trade? Are they the best? Where is my chart, guys? Good. Are they the best or they are the magic indicators? Okay. So the reason why I use these indicators, aside all these plenty indicators, is that I have studied most of these indicators and most of the oscillators, and I've realized that those ones are the best for me. So how do you use them? First, before you begin trading as a trader, the first thing you have to do before you even begin trading on your chart is that you ask yourself, which phase is the market in? That is the first ever thing you should do when you open your chart as a trader. Before you start trading the market, you ask yourself, which phase is the market in? That's the first ever question. Before you even think of trading either price action or indicators, ask yourself, which phase is the market in? So for you to be able to find which phase the market is in, that is when you have to open several charts and then you zoom it out to see what is happening in the market. Either the market is trending downwards or the market is trending upwards. And for it to be easier for us on this chart, we use the currency strength meter to determine which phase the market is in, because we have a lot of currency pairs we trade as forex traders. So for you to be able to determine which phase each market is in simple terms, you open your currency strength meter here, and then it tells you we combine the strongest with the weakest or strongest with the strongest. I don't need to explain this to you again because we've been doing this over and over again, but it's just part of the lecture. So before you start trading, ask yourself, which phase is the market in before you start trading? So that one is cut off. Now, let's come to the indicators on my chart. You can see that there are oscillators. So I have awesome oscillator. You can see that here is awesome oscillator. And you can see relative strength index. Why do I use these indicators and why are they best? When it comes to oscillators, they are best for trading ranging markets. But if the market is actually trending that much, we use moving averages. So why do I use oscillators and how do they help me? Let's come to the awesome oscillator. I use the awesome oscillator to detect whether the market is changing momentum. For instance, you can see at this zone, you can see that at this zone, the market was trending downwards, right? So let's say you want to trade at this particular moment. How would you know whether to go upwards or to go downwards? Now, looking at the awesome oscillator, see here, you can see that there was red bars. And you can see there is a zero line here. Let me explain this first. There is a line in the middle. Can you see? There's a line in the middle. That is the zero line. So if the market goes above the line, it shows that the market momentum is up. If the market if the bars are below the zero line, it means the market momentum is down. But the colors also help. So for instance, you can see here the market was down. It means the market was actually in a down mode to trend down. Now, how do you know if the market is about to reverse or to even make a retracement? You could see that here there was red in change. There was only small green, which is not significant. So when you saw two green, third one is also a red candle, next one is a green candle, you must put in your mind that the market is about to reverse. When you see three green candles consecutively on the downside, it shows the market is getting ready because people are trying to buy the market up. That's why you are seeing those green candles. So you can see that one, two, there was a red candle, there's another green candle. But after then, see, there was red. It doesn't mean the market will not turn out around. It shows you that be prepared, the market can turn around. And you realize that now we got three green bars, one, two green bars, another red, and another red, another green. So now, for a moment, you realize that the market was turning green. It shows you that the market is about to turn around or to reverse upwards. That is why I use the awesome oscillator. Have you seen? So now you can see that when the market gave us green bars, so green bars, the market also moved upward to the upward direction. And then over some time, it began to also rest, and now it began to trend. Now, let's see what happened on the relative strength index. The relative strength index is used to detect whether the market is oversold or the market is overbought. When you say oversold or overbought, how do you understand? Let me give a simple scenario. Let's assume that on a normal day, if you want to buy a Christmas dress, on normal average market day, Christmas dress ranges from, let's say, $120, which is, maybe if you have $120, you can buy a nice Christmas suit and wear it. Now, the highest price of a Christmas suit on normal or maybe occasional days is, let's say, $250. Sorry. So let's say 250. And then between these occasional days and the normal days, sometimes price range is okay, right? So for instance, let's say on the average, the price of a Christmas dress, let's say $170. Now, there was a festive season where the highest price a Christmas dress or Christmas suit can go would be, let's say, 300. That is, let's say, the highest price we've seen in a while. That it shoot up to 300 and it reverse back. But now let's give another scenario. Let's say that this particular festive season, people were having higher expectations. They want to chill because there's money in the system. So people started buying things earlier and things became expensive earlier. So instead of a normal day range of $120 or $250 or $170, the price started from, let's assume that immediately it was November ending or December beginning. Let's say the price started from average of $200. Then all of a sudden, the price of the same Christmas suit hit to the highest, which was on a normal day would be the highest. It hit $300. And let's say the market dropped a little to, let's assume, $250. And then all of a sudden, the market shot up to $500. Now, under this circumstance, we can say that if you get a Christmas suit at $500 at that time, the Christmas suit is overbought. Which people have bought it too much, such that now the price is too high. So we call it overbought. On the other hand, the time that the market was $120, we can see that it is oversold. So what causes these changes in the market? Let's see. When the price hit up to $500, you see the price is too high for just a Christmas suit, which was average of $170 or $120 or $150. So the price is too high. Because of that, what will happen? If price is too high, people will begin not to buy again. Do you understand? People will begin not to buy again. If the price is too low, people will buy a lot and then it will also be cheaper. And those who are selling will lose. So this is how the graph will look like. Let's say up, down, up, down, up, down, up, down, up, down, up, down. So let's say here we bring 120 here. Guys, are you watching? These are the concepts that when you listen to and learn and understand it well, make sure you understand what you're doing as a trader, guys. So pay attention to whatever I'm saying. So let's say here is 120, and let's say here is 250. Let's say here is 170. Let's assume here is 300. Let's say here is let's say 270 or something, and then let's say here is 400, and let's assume here is 500 and above. So this is how a typical graph will look like. On a normal day, the highest price of a Christmas suit shouldn't hit about $300. But now the price of a Christmas suit is $500 and above, which means it's too much, it's too high. So it's likely that the market will drop. So in such scenario, if you're somebody who is selling Christmas suit, let's say you have a lot of stock of Christmas suit and you are selling, this is what you're going to do. You tell yourself that, wow, looking at where the market price has hit, and I have a lot of stocks. If I don't sell them as soon as possible and the price drops, I'm going to lose my capital, because let's say that You went to purchase your Christmas dress at your Christmas clothes from the supply at $400, and then you're selling it for $500 or $600. Now, looking at where the price has gotten to, if you don't sell it as soon as possible and the price drop all the way to $400, which means you have not made any profit, or if you drop below $400, you are going to lose. So if you're somebody who is a retailer, you are selling, you begin to think of selling it as soon as possible, at this level. On the other hand, if you're somebody who is also just a normal person, you want to buy, like I want to go and buy a Christmas suit, then I also say $500 or $600 is too high. So I'm going to wait for the market to get a point where now I realize that yes, it's a little cheaper before I buy this Christmas suit. So I'll wait for the market to hit, let's say, back to the $300, then I'll also buy upward. So you see, two minds. This is when we bring in oversold and overbought level. So the purpose of the relative strength index, which is the RSI, is to tell you the oversold and the overbought level of the market. You get the difference? To tell you the oversold and overbought level of the market, while the oscillator tells you the momentum of the market. That's what I use the oscillator for. You see, if you don't know the use of an indicator and use it wrongly, you might think the indicator doesn't work because you are reading different information from the indicator. But I can tell you for a fact that if you know what you are going to use the indicator for, you really like the indicator. So now, I have this one to tell me the momentum of the market or where the direction of the market is trying to go. And I have the relative strength index to also tell me whether the market is overbought or oversold before I even think of trading my price action strategies on the chart with my candlestick patterns. So guys, now you understand the difference. So if you have these indicators on your chart, then it's going to make your trading very easy because now you have a window through which you can use to understand the market. So how do you insert these indicators? Simple. You go to File, you go to Insert Indicators, and you go to Oscillators, and you insert your Awesome Oscillator. Where is Awesome Oscillator? No, Awesome Oscillator is under Billy Williams. That's Awesome Oscillator. When you click on it, then to be inserted. And what are the settings? So when you check here, when I right here and go to Properties of my indicator, Properties of Awesome Oscillator, you can see that it has the default settings because that's how it was made. Just default settings. Where is it? Good. So just leave the Awesome Oscillator at default. Okay, when you just click, it will just be installed. Then the the relative strength index, which is insert indicator, and you go to insert indicator, you go to oscillator, then RSI, which is the relative strength index. They also insert it. You see, all these information I'm sharing with you is per what I have used and what works for me. In the same way, on the other hand, another guy will also show you a different indicator and what works for them. So the best way to use an indicator is for you, the trader, to understand what you're using the indicator to do. So we realize that since we began, I first explained that before you even think of trading, you start trading with what? Your currency trend meter to determine which phase the market is in. So the first indicator I use to trade is what? The currency strength meter. To tell me which phase the market is in. That's number one. Two, I now come to the chart and say, okay, now we are trading ranging market. Using the currency trend meter, I can select some markets which are likely to range and some markets which are likely to trend. So if let's say I want to trade ranging market, then I'm going to use my price action strategies that I've taught you here on this channel. At the same time, looking at the relative strength index to give me more information whether the market is oversold or overbought. And now, let's come back to this chart. Now, if we say the market is oversold, we want the market to come down. So the RSI works like this. The RSI, let's assume that you have the RSI here. When the market gets to the overbought level, it will begin to come down and oversold level will begin to go up. So something like that. Which means the RSI works best when we have ranging markets. If the market begin to trend much, you can't see the good use of the RSI. We use moving averages to trade the market. But if the market begin to range, we use the RSI to determine. Or if the market has hit the highest bottom, that's the highest top that you want to reverse, you can also use the RSI to determine. So you could see that at this level, The market shows that the market is oversold, so it's preparing itself to go upwards. It doesn't mean that the moment the RSI crosses the line, you should just buy or you should just start buying. No, we don't do that. It just to give you an idea that get ready. The market is likely to go up, or the market is likely to reverse. So going up doesn't mean that it's going to automatically move upwards, bang, 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 just like the market is trending up or no. It could be just a minor retracement, or it could be a major retracement, or it could be that the market is just trying to just turn its direction. So that's the use of the RSI. So you could see that at this point, look at this side. You could see that at this point, the RSI hit the top level, which means the market is likely to come down. Coming down doesn't mean the market is coming all the way down to the bottom, but the market is likely to reverse. That's all, just likely to reverse, or the market is just turning around its trend. That's the use of the RSI. Guys, now you understand now. Good. So I don't want this video to be long. What I want you to do is that go to your chart and you to use the same concept. I didn't just say just go and install the RSI, and when you see that it has gone down, you buy. When you see that the volume, when you see that it's turning green, then you start buying. No, I'm just telling you that you have to use those ones to understand what is happening on the market, to tell you what is happening on the market before you trade your price action strategies. Do you understand the difference? So go to your chart, install the RSI, and then install the awesome oscillator on your chart, and then just try and practice it. Read the market, see the time where the market was red or the time when the market was turning green, and see if they match. If they match, it means that now you're on point. Look at this side. The market was ranging, right? So you can see that the awesome oscillator was flat. If it's flat, it means the market is trying to range. That's the idea it gives you. It means there's no much volume in the market. People are not interested in buying or selling. So you can see that at this zone, the market was trying to range. It was just a minor range. That's what it also tells you. Very simple. But if the market is beginning to have more volume, you see that the bars will be longer. The bars will be longer. Can you see? Longer bars. And some are green, some are red. But it just shows the retracement and the ups and downs of the market. Very simple. So these indicators help me to see through the market. So if somebody say if there's no better indicator, I'm telling you that me, there's better indicator I use to trade for me. So if there's no better indicator, it means you don't know the use of the indicator. Or on the other hand, indicators actually lag. They lag. So if you don't know what you're doing and you think the indicator will tell you, hey, click buy, then click buy, hey, click sell, and click sell, it means you are messing it up. Indicator cannot tell you when to buy or when to sell. No indicator can do that. Some indicators can tell you that, but in reality, you lose because price is king. Price action is the best way to trade. Just that price action alone cannot help you become successful and like just analyze the market easily. You need a helping hand, and the helping hand is some indicators to incorporate into your trading to give you much broader idea of what is happening in the market. You get it? So some indicators lag. If you follow them that they've crossed this, they've turned green, so you're going to buy, you're going to sell, then you're going to lose your account. The same way, even some price action strategies also fails. But if you combine indicators with price action, you get a broader view of the market, and you know actually what you're doing as a trader. So if the market is oversold, you can see that okay, now looking at how the price has gotten to, I think it's too high. So let me wait. If I want to buy again, let me wait market to reverse before I sell. I buy again. Or if I want to sell, then is it the right time to sell? Looking at the oversold level, let me compare it with the chart. Now, you now go to your chart and use your price action strategies to determine where to enter correctly. So there are no better indicators unless you understand what you're doing with the indicator. Do you understand? Unless you understand what you're doing with the indicator. So go to your chart and install these indicators. There are others too, you can also learn from them if you like them, but it's up to you. But most of the indicators lag. Every indicator take their data from price. So if you don't know what you're doing and you install this indicator, you think it's going to make you billions of dollars, then it's not going to happen. You just have to make sure that you understand what the indicator is trying to teach you and you use that knowledge to trade the market. So that will be all for this video. I'm Seto was your mentor. If you enjoyed this video so far, hit the like button, subscribe to my channel, and come back every time to watch such videos.